of this stuff is pricing in higher crude prices, and I do believe that while crude has had a huge run here, and I'd rather reload at much lower prices, we could just be getting going on this crude trade. So, um, just be careful with it. I know it's very headline driven, but the fundamentals of crude, in my opinion, have been setting up for this for a long time as well. So, and when prices react quickly like this, it's not like there's just a bunch of production that, from the US producers and elsewhere that just comes back online, quickly overnight. Like, it takes time to get rigs out there and to get pumping and producing and drilling again. And, we're not going to be able to make up um, a big supply shortage in short order. So I don't know what Trump might have up his sleeve, but I don't see this stopping anytime soon. Well, it's materializing now, right? We just lost your, or I just lost your audio. Let me see. Now I can hear you again. I had to just click and re-click your button and it came back. Okay. Hmm. My feeling is that the flight to safety right now has been in these metals, and that's partly why you're going to continue to get a push higher in crude. Um, this is easily could be a stagflationary kind of environment. I mean, you have to question whether or not even a super boom productivity thing with AI is ultimately um, inflationary or deflationary, right? It- So it may be in the short term that we keep having this huge super boom thing, but in the long term, it's sort of like the old thing about like developing countries versus developed countries. And the more developed you get, the more sort of deflationary things are because the technology or the education of the population or however you want to look at it starts to um, create efficiencies in the workforce. And so here we are with AI, and it's like it's replacing jobs, then what do all these people out there that are educated, we're all getting so educated with everyone has a college degree nowadays kind of thing, right? Like there's just more and more kids from the younger generation that have more and more education. They come out of school and they have no jobs. So there's kind of a sticky thing that could occur here that again, this is more macro. It's like over the next 10 years, we may just kind of muddle along sideways for a while and have these moments where you get downdrafts and then updrafts and then, just big range bound type trading, which is sort of what we've been in, right, for the last however long, 6 months, 8 months. But when you start looking at the kind of move we've had in something like crude, which is so important to the global economy, it's similar to the way rates went from zero, and they were at zero for so long, and then they spike up, and everyone's off sides on their positions. But then it might take years for the housing market to actually recover on a full scale basis. I mean, regionally, there's strength and stuff in these pockets, but ultimately, like, there's still all these people that have really low mortgage rates, and there's no real incentive to do anything with that unless you absolutely have to. And that's kind of what happens with a big spike in crude oil is the market got way complacent and overly used to 55 $60 oil, and all these people talking about how it was going to go down back down to the 40s, and Trump talking about how he wanted it in the 50s, and he thinks he can control the prices of these things. And once it starts readjusting, um, that it quickly can become a big headwind for the markets, because it's not priced in. So when you start looking at what is really getting hit today on some of this stuff, I mean, I don't know. You've got it's like Tom's saying, it's very conflicting because there's both sides to the story are absolutely like viable, right? Well, I can get stubborn sometimes, so it costs me money sometimes, but it does help me if I'm trying to lean one way or the other. And dad always taught me it's better, like you do, Manny. It's better to be it's easier to trade from one side of the market. It's easier to have your thoughts of, okay, I'm a long bias trader, so in a day like this, you can say, okay, wait, 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 and then once you get your setup, you take it, right? um, and I kind of like to trade both sides, and that also, like, it causes me to be confused sometimes, and then when I'm confused, sometimes I feel like every little wiggle in the market, I'm missing the turn or I'm missing a trade, and so then sometimes that causes me to overtrade a lot, and I lose a bunch of money doing that. So, um, right. But Tom, Are you watching bonds? So bonds are rallying here, so see if the market reacts to those, you know. What I do a lot in my trading is I try to notice what other markets are doing, and then if there's a reaction in everything, you know, try to identify what a driving force might be like as an indicator. Because sometimes with these heavily correlated risk off or risk on days, you can figure out, oh, okay, they're buying bonds again. And if that means that we're going lower in the equities, then you know you can sometimes it can help you jump in on an entry when you know you might have missed it otherwise because it's so fast. Think about this too. The ATR, 5-day ATR right now is 100 points. Our range in the overnight was 143 points in the ES. So, how much, if we are going to really expand that to the downside, I'm looking at this as extreme move type consideration. Um, a move down to the 200-day at 6610 or 6600, or depending on where you want to calculate it with your slope, and that could happen quickly and violently, like Manny says. And like, as a short side trader here, that's kind of what I'm looking for, right? It may not happen today because we've had a big overnight range, 143 points. But there's been so much buying for so long. Like, what do you need to buy here, and what do you need to add to your long side risk exposure here? I mean, frankly, you just really, it's more like sit on your hands and see if this thing goes a lot lower. It should at least test the 200-day. If oil especially keeps going higher, like it's gonna happen, right? Like, now, if oil starts collapsing and wants to close the gap, and we get news about the war and everything reverses, that's great. But it's certainly, like, a lot of times you don't want to short when you're well into the hole. But on the other hand, have these bigger levels in your mindset, so that like, yeah, if we break here, like, there's no reason for this level right here to hold anything. We're only, I said it about 10 days ago on the YM, as a false breakout to the upside. If we measure the move from the all-time high, we're now only like 5% down in the YM from the all-time high. So that's pretty garden variety. That could turn into an extra 5% pretty quick, you know. Think about all the stocks that make up the YM or the Dow, and how much does crude oil affect those companies' bottom line? And so when it has a move from 55 to 75 in short order, it's everything's out of whack here. So there's a if you think it's going lower, you can easily be looking at this and trying to short a retest here of $40 or whatever, 67.40 on the ES with the 4 or 5 point stop. So that's what and if it works, it works. Um, I think you probably would have a better chance if you can get a rally back up to the open again. I think they're going to sell that 72 level again if it goes back up there. So here you go, Tom. Bonds are still printing higher. See if the advanced declines are trying to hold here. So if the advanced declines can try to rally back up to minus 2000 or so, this could be a little false breakdown. We have an S two level on my sheet is 6712. I think it could hold the 67 quarter though, so I'm watching this pretty closely here for a long setup. What the just happened? I don't know what just happened. There's a divergence happening here, I think, in the advanced decline. So I think we're gonna get a pop here, but I just tried a quick little long there and something happened on my, I must have a risk thing on my rhythmic on this account. And as soon as I bought it, it sold it back out. So now I'm gonna play around with that for a minute. And I'm like, No, it's, I mean, but it's look for these things that, so what I focus on here is the advanced declines starting to turn and hold a little bit. So, and now you get a little pop. So now, I mean, the setup is to buy this retest again if it tests 30 level or so, and use a 7 or 8 point stop, or you can try to buy it at 28 or something and use a 4 or 5 point stop, right? And then ideally, and what I would expect is a retest of the open, and that's where I believe the sellers come back in. 67.70, 67.72. Sometimes what I like to do is put in my short sell order just above the open, like 2 or 3 ticks, and see if you get a false breakout there. And then you can use a tight stop on that. If it goes ripping straight through, then it might take out this regular trading session high and then rally back to the overnight midpoint, which comes in at like 68.14 or something. But where here, let me, I dropped my screen share, sorry. But let me blow this up. Here's what I look at is my faster moving average that's starting to turn up. In order for it to actually curl and turn to the upside, we need this now second. This is sort of, we've got a first wave of short covering. Now we're getting our pullback, and that's what gives you a nice definable trade setup. And then we should get a third wave that would be at least a measured move. So from 19 to 40 is 21 points. If you can get long in here around 26 or 25 and use a 4 or 5 point stop, then your measured move should go back up here into the 50 area. And if you get up into there, you've got plenty of fuel to maybe get some more stops back up into that opening price range, in that 70-72 area. So that's what I kind of, my whole thing is, if price is below the opening price, I should be biased towards the short side. But my whole trade setup revolves around this 1 minute chart, the shorter time frame moving average. And when it's sloping down, I should be short. And when it's when it's sloping up, I should be long. And once you've printed a bar, especially a full bar that's back above this moving average, that's at least a warning sign. So if I were short in here, I'd at least be putting my stop right here at 42. And that's frankly what's going to drive that third wave higher, is if everyone has their stops now at 42, can either try being long down here to see if they run the stops through, or you can try it on a long breakout at 42, scalp a couple out for 6 or 7 points, and then see if you get a runner back up to the open or all the way through. So those are kind of how I look at my setups as they develop. And when I'm watching it against something like the advanced declines, or like, again, Tom was talking about the bonds. So bonds have now started selling off. So there's a correlation here where you may not have seen that correlation yesterday, but today you start seeing it. So the bigger players start recognizing that they need to adjust those positions, and that correlation starts developing, and you can start spotting it and taking advantage of it. So if the advanced declines for me get above minus 23.30 or so, then they should, in theory, actually test the high of the day. And I mean, you might see the advanced declines get all the way back to minus 1300, and that wouldn't necessarily defeat like a selling kind of market, but it should give you a really good move to the upside. I mean, maybe 50, 80 points, the way this thing's been running. Yes, sir. If I minimize this again and you start seeing all these correlations, and now ideally we're going to put in a 2-bar reversal on the 15-minute chart and take out the high of that previous bar at 52. And then everyone might be thinking, okay, the short-term low is in. The 53, 51 level will still be pretty big as far as, do we hold that previous low and move above it, like on a look below and fail, the way Manny and these guys like to call those out. Those are such good trades, when you get them, and when people can help you call out those levels. I mean, Manny's write-ups in the morning and stuff are like, they're so useful for when you're just trying to identify. What I used to do was kind of like get in too early, and I've gotten a lot better of looking at the level and then waiting to see if price gets to that level and then waiting for the setup to go, right? So it's like I was kind of watching, maybe will we get to 67.12? Well, we didn't get there, right? And a lot of times it likes to hold like 67.25. Like it's almost like old school trading, like on the quarters, but it's blown out to like the quarters in the thousand handle, like 67.25 holds. Now it could easily run back to the 67.75, or think of it this way: if we're going to do a fulfilled ATR move in the regular trading session, we should still move 100 points in the regular trading session. So if the low of the day is in 67.19 or so, again 100 points higher, 68.19, and just you can use some of these levels and some of these things on the sheets to be able to make quick calculations in your brain. Or like Neil's Delta trading platform, he has a lot of these things programmed into his charts, the midpoints, the overnight highs and lows and midpoints, all these things that just are there and print for you. And they're meaningful because the computers and the algos use all of this stuff mathematically. And that's why when a level holds, don't fight it. If it's held, you better not fight it, because it can just hold and squeeze you in the wrong direction for quite a long time, right? So, all right, I'll quit for a minute. Advanced declines are trying to rally here. And look at this heat map as well. It's setting up well right here. You could have bought that retest of the 30 level. If you are a more conservative trader, you can wait here. Now see if it just ticks one tick higher than these two candles at 33 and a quarter. Or let's see, what was that? Sorry, 41 and a quarter, 41 and a half. I want to see it tick 41 and a half and then buy the next pullback to the short moving average if you want to be long, okay? That way it keeps you out of trouble. If you're trying to pick the bottom, you know, here's your chance at 20, 28, 26, 25, and you can use a 5 or, you know, 4 or 5 point stop, tight stop. Like when you can identify something like that on high volatility days, it's a high likelihood you're just going to get stopped out and just rip through the lows here, whatever. But those are also the trades that you can put some size on, right? And like take that chance, because if it bounces just a little bit, you can scalp out of 1 or 2 of them and have a free entry, you know, runner that, you know, now if it starts to rip, it's hard to get in because it doesn't give you a chance to get in, right? They just start taking the stops because there's no sellers left. And I want to quickly sort of touch on that too, is that what the way a lot of things that happen with how markets move and how markets price just has to do with where there's a lack of buyers and sellers. So in other words, if prices are moving down, it's not necessarily that everybody's selling. It's just that sometimes the buyers, when they're not there, and if you're short and you can just keep canceling and lowering your bids and lowering your bids. And so sometimes that's part of why the price moves in such a fast way, is because the book gets thin and, you know, there's just not a lot of actual trade going on. It's sort of like it looks like there's volume, but it's actually not as much as you might think, or, you know, and none of this is, it's all sort of like hard to translate in real time looking at a 1-minute chart. But, you know, that's why I kind of worry about the downside. Bigger picture is that, you know, how much more do these institutions need to have long side exposure at this point, you know? And so if there's not, you know, rotationally, I think it's important to watch where are the rotations happening. And but just knowing that everyone was so loaded up, you know, it's not like that everyone's like running out the exits, but they may not have any more reason to add to that long exposure. And so then when those buyers have evaporated, you know, that's when the day traders can push things around and the computers can push things around. I think one of the first lessons I learned in terms of that whole scenario was the actual housing crisis in 2008, because um, if you equate it to something that's illiquid like a house should be, right? It's not typically something you can just buy and sell and move around really quick. That's what happened. As soon as everybody on the streets got their for sale signs out, and you can just walk down the street and see everyone trying to sell their home. Well, what's the the realtor going to tell you? They're going to say, look, everyone's trying to sell their home right now. If you want to be competitive, you need to lower your price, right? And if you do, you might be the most attractive home out there for the one buyer that's in the market, right? But if you don't lower your price and then the rest of the sellers around you are getting the same information from their realtor, you need to lower your price, you need to lower your price. All of a sudden, people around you lower their price, and guess what? You're out of the market. You haven't lowered your price, and so you're trying to sell at a higher price. You're sitting in this subdivision that's, you know, sort of like the houses are all the same, right? I mean, there's not, obviously custom homes, you can differentiate yourself better. But if you're in like a big subdivision and all of these models are generally the same, and, so that's kind of what happened in 2008 when everything got so crazy to the downside is like, home buyers were coming in and they would have 70, 80, 100 homes to choose from. So why would they pay up a higher price for something that's, so that's kind of how I equate some of the bigger supply demand moves in the equity space is like sometimes the boat just gets too full, right? And you've got to have these corrections. Yeah. So here I've got what I was saying before. We printed 41 and a half. So now I think this is a very viable long side entry trade. If you can buy it again at 34 with a stop below these lows, 10-point stop. Yeah, it's a little wider than you might like, right? But if it's going to print a higher low here, the shorts right now are worried, right? They're watching this closely to see, is this going to explode up through here? So that's where the dynamic starts to turn, and the computers and the algos are starting to say the same thing. They're programmed to start buying these highs once the crossover occurs and price moves above this moving average here. Those high frequency trading algos are programmed to buy highs. They buy them and run stops, and they kick out some volume, and they keep buying, and they kick out some volume, and they keep buying. And that's how the programs actually work. So again, it's a 10-point risk. You can take it as a less of a risk. You can take it at 34 and actually use a 4-point risk and say, I don't think it should violate this green bar. You've now had, and then an older traditional kind of scenario, you got 1, 2, 3, 4 green bars in a row. Here's a fifth. You can buy the break out of that little doji if you want with a stop below this. So there are ways to use tight stops even in volatile markets. And just watch for the setups, look for your divergences, look for ways, different correlations that tell you what may or may not trigger the reversal, because the reversal trades are always the best risk reward trades. When they go your way, they go for a long time and you hold them. And Manny's great at that too. A lot of the guys in the room are great at that. I'm probably a little more, I need some work on not tightening my stops too much, because I tend to get shaken out of trades because I'm afraid of not letting my runner go a little bit more, right? Like I'm afraid of giving a profit back. But anyway, that's just right here. This looks good to me. We should get a little pullback. If you want to be long, we should get a little pullback, and we should at least trade back up to, in my opinion, to the opening regular session open. I gotta try to switch over to another account again. I got locked out of my account for some reason on one of those. I was trying to play with those risk parameters, and I was trying to use a trailing minimum kind of thing, and I don't really understand how that works. So I actually took a long entry at 23 and a quarter, and it immediately kicked me back out for a 1 tick loss because I was setting. And of course, if you're not watching crude right now as part of what you're trying to correlate to, just I think you should be, because that's really such a major thing here. And the 78 level in crude, I mean, it might not go right ripping through that, right? We've just come a long way in a short period. Yeah, look at that. Look at that. So now the shorts, I mean, have to be wondering how much can this actually start squeezing, and it can start squeezing a lot. And ideally for me, like I want to be long crude again, but I don't want to buy it again here. I want to see it come back down and retest the 72s, or fill the gap at 67. Boom. I hope hopefully some of you were able to capitalize on that long. That was a really nice retest. This is the one that was really nice, was that retest down to like that 31, 31 and a half level. So after it made this one bigger green bar, and then it came right back to sort of those previous highs. Sweet. So watch the action, Chris, if you're still long here, and others, watch the action at the open. If it trades to 72, 73, see if it just goes ripping through, or if you get sellers coming back in. So a lot of times that is another good short entry potential, but what you want to do is wait for it to touch, and then yeah, and then form some kind of reversal pattern. However you tend to trade those. Yeah, looks good, huh? Yeah. Yep, a lot of times when we open really extreme like that, one way or another, throughout the day, it'll correct more to something reasonable. That's why I say, like, if the advanced declines can get to like minus 1300, to me, that means you're probably trading up back around 6800 or higher, right? 6819 would be that ATR fulfillment to the up. I just am looking at the regular trading session now. If the if you use the 5-day ATR as your range on the regular trading session, if the low is in, then just add 100 points. So 67.19 to 68.19. And that could be a reasonable target to exit along, if you're long here, right? And that actually like lines up pretty well with the midpoint of the overnight range is actually 68.14 and a half. Yeah. And you see how I'm bearish on all this stuff, and you see how that was just a great spot to start looking at, hey, maybe we ought to be trading long. Right. I mean, if you think we've gone far enough, and there's too much risk now the other way, like the war's over, we've won. You can be long here and short the crude market as a swing trader with some bigger stops. Like, you can take this thing right the other way and have it, you know. That's why I don't necessarily want to reestablish a long crude position here, right? You can, but thanks, David. I mean, yeah, the thing I like about it is it helps me keep myself honest to my own systems, which when I follow them, I do well. When I don't follow them, I get run over. And believe me, you know, it's hard figuring this out on a consistent basis over years. You've done it really well, I think. I'm still figuring it out. So, but when I talk through it and I'm on this, I have the audience, it just kind of helps me with my own trading. So that's why I enjoy it, and I appreciate anyone who can glean anything I'm trying to say sort of to myself, you know? You can easily just, based on the opening price principle, you can try a long here, and it's still not a chase, right? Like, it's only, these things are only a chase or whatever after the fact, but if it retests the open, you can try buying like 73 and a quarter and use a 4 or 5 point stop. And if it holds the open, that's kind of what the machines look for higher, you know, price action. And if we simultaneously get crude dropping back through and testing its open at 76 and a quarter, 76.21, you could have a flush in crude where it simultaneously creates those rotations, where it's just all computer driven, right? And my short moving average here is lining up perfectly with the opening price. I mean, it's likely you can get a flush all the way back down through to the longer moving average to the 60 level. But the squeeze that you might really like is if it only retests the open and then immediately starts ripping higher, you know. We got up to plus 1,000, like 1,100 upticks a couple times there. So you can also correspond or try to correspond your entries when you're using the 1 minute chart and you're trying to do this on short time frames with the ticks. And we always used to have a setting when we were using e-signal. There was like a bell ring setting that when we would get 1,400 up or down ticks, it would ring the bell for us. And I'd almost always either cover some of my position that was going for me or try getting in on a reversal kind of trade, on those extreme ticks, because it works a lot of times. So I have my tick chart directly just right next to my ES and my CL charts, but on my middle screen just off to the right here that I'm not sharing. But it helps me, like, we just went from, in 2 minutes, we went from 1,100 upticks to down to 100 upticks. So that's a pretty good swing. So if you're buying it right there at 73 and a quarter on the retest of the open, now you want to see those upticks go back. Like, so it got down to like 120. Now it's all the way back to 560. Can it print 800 again real quick? And maybe even 1200 again or 1400 again. And you have a trade that works instantly, at least enough that you can kick a contract or two out. Like if you're trading a 3 lot, you just sell one at +5, sell one at +8. Like, I tend to sell them at +3 and +6 because if I'm using a 4-point stop, um, I can trail that, and it's like all I need to do is get one contract off, and I've got a break-even opportunity, or even a slightly profitable opportunity. Because right there, if you've bought it at 73 and a quarter, and you sell one at 70, on my version 76 and a quarter, and you're trying to sell it at 79 and a quarter, but you miss it, but then you have you move your stop up to just below this candle now, and you're likely to get stopped out. But also if you don't, you know and here's where a lot of day traders kind of look at, do we get a little false breakdown now of this green candle, right? So you can buy, I think you try buying the matching low, or like one tick above it. And again, if you want to use a tight stop, it's only, put it in at like 3 or 4 points. Anyone who's short right now is putting their stops in. If they don't have them in already, they're putting them in above 86, right? There's more stops above the Yeah, and then there's more stops above the regular open at 96, right? So you've got 86, 96, and 03 are just loaded with buy stops. So, the machines absolutely want to target those. There's Whether they can do it is another question, right? But it's sort of an easy push for them to make, to just take that liquidity, know that the buy stops are up there because they're taking the liquidity and they're selling into the buy stops that trigger. I mean, that's how these program trading systems work, and that's what makes them so powerful. Oh, yeah. Oh, yeah. Yeah, because look at how powerful that starts to become. The more they take those out, the more buyers come in. The people that are flat come in looking to get long. I mean, that dynamic is absolutely the way these trends run. And that's why, like, when you see me fading this stuff and adding the losers, Jimmy Mayo's really good at pointing that stuff out, but I'm the fuel to the fire on the wrong side of the trade. Yeah, totally. Now, without like a news catalyst, we could just be, again, how far will this run? And if you want to start looking at some measurements, the first little move was about, right, 21, 22 points. Now this move, we've gotten 26, call it to 84. That's a 3x move measured from here to here versus the first wave. your pullback on that first wave was 20 points. This pullback was only 84 to 73 was 10 points. But that could be considered your fourth wave, your pullback wave. And now we're in a fifth wave higher. And if you want to see it kind of measure out properly, then you might get a 20-point move off the 73s. You might only get a little less, right? Because if it goes 1, 2, 3, 4, 5 Elliott wave, and then yeah, and then we kind of wrap this up here at maybe 93s, then we reverse. Well, now we're just in this range, right? And then it gets even harder to trade it. Advanced declines are getting closer to their high. And I think they want to take it out. I mean, minus 2036 is the high from this morning on advanced declines. And here's one that if you're watching oil right here, you could still even try to buy the ES here at this 83, 82 level and just watch oil. And if oil starts to break hard, that still could be a really good entry in the ES, right? Even though I think it's a little bit aggressive because they quickly flush the ES back to the 66. Ideally, anyone who's short now is going to be wishing that the price will pull back to 60, 61 on the ES. And that's where this longer time frame moving average for me comes in, where if it's starting to try to reverse and curl up, that's a good spot. So look at crude 76 and 3/4. Think it probably wants to retest that open at 76.21, and I would guess it would try to probe back down into the 74.5 level before the day is over. A little bit, but now watch advanced declines at the same time, and they're pushing towards this high again. So see if you get that divergence. And look at crude is trying to flush here. 76 and a half goes. It should trade the opening print pretty quick. And that's your correlation to watch. So what's happening? Is there news? Is there something, So let's see if they buy the ES here again, right? This could turn really quickly, really fast. So ES giving you another good shot at the open. And like to keep yourself out of trouble using like David's kind of system more is instead of just buying the ES here and think, you may get that hard flush and just get stopped out immediately. Instead, you can wait for it to recover that structure and buy it again, around 81, but waiting for it to move back above and hold the open. And that'll keep you out of some trouble and out of some losing trades if you're less sort of risk averse on your entries. Um, and now think of this for your measured move, right? Maybe this entire thing was wave three from 26 to 89. And maybe now we're in our wave four, which if it's a measured move, it should pull back 20 points to match the wave two, right? So from 89, if it trades back down to 69, which it just did, that's a measured move, right? So that could be our wave four. Now, if we look and watch to see if it starts moving higher again, we might just now be getting ready for a wave five, which could then target those upside top stops. If you're thinking long, right? I'm not so sure at this point. I still have this bearish sort of overall bias to my whole personality, so it's hard going against that sometimes. But and right now, like if I want to be short, okay, instead of you can try to short it here with a 10-point stop, right? Or more conservatively, you can also try a sell stop below this little low there at 68 and a half. It gives you plenty of downside room to scalp out of a couple, um, because if it takes out that 68 and a half level, it should follow through quickly. Right now, all the longs are putting those stops in right there at 68 and a half. So if there's really going to be some triggered selling there, it should easily trade back down to 60 and then 52 or so. So you could scalp out of one there, scalp out of another there, and then see if it just makes another big wave lower for your runner down to say, 66, 80, or, see if they take out that figure. But if you're like David Dubay, this is kind of perfect for him, right? So we got our wave four pullback. I think what his system is kind of telling us right now is, hey, it held that open. Now it's printed some green bars again. And now here you're regaining that structure, and you can maybe try buying it again at 81, and you have a little bit of a safer, uh, you know, a structure that's a little bit sort of easier to follow that way, right? Instead of just trying to catch that falling knife that's occurring that could have just completely gone all the way through. Yeah, I think it's launch time right here. But look at advanced declines, they're still trying. So watch the YM here and watch advanced declines. You can try them at 77 and a quarter with a stop at 71 and a quarter, 6 points. That's not bad for long. Later, Manny.